Hey, I'm Jason, and this is Supply and Demand Daily, where I tell you what we learned about the economy today. So let's go ahead and get started. I have three major data dump indicators for you today. We have existing home sales. That is the number of sales of homes that were not just built. So not new homes, existing homes. We have the Philadelphia Fed's Manufacturing Survey Index. So we're going to talk about that. And we have some jobs data, which is telling me that the expansion in the labor market might have actually ended, and we might be seeing some unemployment around the corner, but I could be wrong about that. I certainly hope I'm wrong about that, but let's go ahead and get started. I'm going to move out of the way. Now, the first thing that we're going to start with is existing home sales. So this is a 23-year chart going back to 1999. This is a privately provided metric that comes from the National Association of Realtors. So please ignore this this incorrect source down at the bottom. That's left over from yesterday. I should have replaced it. Oops. But anyway, what I wanted to point out with this chart is this is the housing bubble that led up to the great financial crisis and the recession that followed. As you can see, it peaked in about 2005. And then if you know in your head maybe anything about home prices and the history of them, if not, that's okay, of course. The decline in home prices preceded that by about 9 to 12 months. So it was not until almost or around a year later that we saw a systemic fall in home prices across the United States. And so the reason that I point this out is that we still have not actually reached a level of activity in the housing market in terms of sales that is matched the basically the pre-crisis bubble times of the early 2000s. So I found that was pretty interesting. Again, this goes back to 1999. And then I wanted to just point out a couple of levels. So in July of 2020, we were looking at a monthly rate of increase of 22%, which was absolutely insane. So definitely all the liquidity in the housing market really caused a lot of froth and a lot of activity. And now we're sitting at a level of negative 2.4% from last month. This has been the, I want to put it this way, 4 out of the last 5 months, as far as this metric is concerned, have been down. So we've been looking at fewer home sales than the month before in 4 out of the last 5 months. So certainly not a good signal there, at least for home builders and maybe homeowners if you're using the equity in your home to take out loans and buy vacations to Panama or something. Anyway, so to move on from that, I zoomed in a little closer, and this is really similar data, but just in a closer lens. So this is data going all the way back to February of 2022, and what these green bars are is the percentage difference between the level of home sales in February of 2020 and whatever it was that month. So the cycle peak was actually January of 2021. That's when home sales had gone up the most, and that was about 18%. And now we're sitting at basically 0% difference between now and February of 2020, prior to the pandemic and prior to the recent very bubbly housing market. So just wanted to point that out as well, give that a little bit closer look. Now we're going to move on to, and one thing that is pretty correlated with this is actually home building stocks. So this white line is an index that tracks the value of home building stocks, and as you can see, that has declined by 25% over the last 3 months, and that is compared to just a couple of relevant stock market comparisons, the S&P 500 and the Dow Jones Industrial Average, which are on the decline, but only in the single digits. Now, the home building stocks have been going down ever since basically December of 2021, which basically correlates with the activity in the housing market slowing down. And if you go back through history, you find that actually home building stocks are pretty good predictors of where the housing industry is about to go. Kind of an underappreciated little canary in the coal mine there. But anyway, now I'm going to move on to the Philadelphia Manufacturing Index. And if you're curious about what exactly this number means, I encourage you to hop on over to YouTube and watch my video on the New York State Manufacturing Index, because it's basically calculated the same way. But to give a brief explanation, this blue line here is the index that shows what the manufacturers in this region, which is mostly Pennsylvania, what these manufacturers are expecting business activity to be like 6 months down the road. And then this yellow line is an indicator or an index that is calculated based on their general business conditions as of the current month. So we're looking at May 2022 here. This was only collected a couple weeks ago, so it's pretty current data. And the reason that I panned all the way back to January of 2007, that's when this chart begins, is just to show the future indicator and the difference in the future in the forward-looking index. So again, this is what manufacturers are expecting their business conditions to be like 6 months down the road. And the only other time that we've seen it breach a negative level going back at least 15 years was during the middle of the 2008 and 2009 recession. So I wanted to point that out because to me that's pretty crazy. It's sitting at a level of negative 9.5%. And the reason that you see all this volatility here, we're going to look at another chart that doesn't have as much, is that this data is not seasonally adjusted. So in different kinds of businesses, there's a natural fluctuation of activity throughout the year. For example, Walmart, Target, and businesses like that see a huge upswing in their activity in November and December while people are picking up last-minute Christmas gifts for their mother-in-law or what have you. But then it looks like they have a huge downfall in their sales immediately following in January because people have basically done most of their retail spending, and then it picks back up throughout the summer when people want to go on vacation and all that kind of stuff. Seasonal adjustment seeks to eliminate those kinds of fluctuations, and this data is not adjusted, so that's why it is kind of all over the place. But to pan out back to a seasonally adjusted series, this is also going back to 2007. And as you can see, the level in terms of the future expectations has not gone down. It has not gone down below negative, but it is sitting at the same level as the index of current conditions, which is pretty pessimistic if you ask me, because in most of this data series during economic expansion, these manufacturers report that they expect future conditions to be better than current conditions. And so that's why this blue line is mostly, for the most part, hovering quite far above the yellow line because there's that optimism baked in. And now we see these two lines basically intersecting. And so what that means is definitely that these manufacturers are both feeling the brunt of rising input costs and expecting there to be a significant drop off in demand because, they know what inflation does to consumers' desire to buy things. So just wanted to point that out as well. And then lastly, a look at the labor market situation. So we have initial jobless claims. This is the number of this is the number of people who are filing for unemployment benefits as reported by the state governments, because that's who issues unemployment benefits. And I just wanted to give some perspective here. This goes back about 3 years to January 2019. So in March of 2020, we were sitting at a level, so this is before the state lockdowns were initiated, sitting at a level of about 198,000 unemployment claims per week. And then now we're sitting at a level of about 200,000. And by the way, this is a 4-week moving average. So it's designed to sort of fluctuate or eliminate the fluctuations from week to week. But the reason that I wanted to mention this indicator is that even though it is pretty optimistic in terms of the long run averages, we have seen a pickup in the 4-week moving average for each and every one of the last 6 weeks. And I was looking through the data, at least the last 15 years of data, and I really didn't see any other times when this 4-week moving average picked up for more than 6 weeks at a time, other than leading into a slowdown in economic activity. In other words, a recession when unemployment was about to go up. So usually you do see these fluctuations, but they're not more than 4 to 5 weeks. So if I continue to see an increase in this, then we might start to see higher unemployment numbers in a matter of maybe a month, maybe a couple months. But it's not just this that is sending that signal. I was going back through the most recent jobs report from the Bureau of Labor Statistics and just wanted to point out a couple of details that didn't usually make it into the headlines. So they reported that we added 428,000 jobs in April, but sort of hiding under the hood in that report was some other details that kind of told a different story. So on net, we certainly added jobs, but if you look at the labor force, that's the number of of people who are both employed, they have work, and the number of unemployed, the people who are looking for jobs, the labor force actually declined by 350,000 people. And so just a quick thing to know about the Bureau of Labor Statistics: if you have not looked for work, so if you do not have a job but you're available to work and you want to work, but you do not have, if you're available for work and you want to work but you have not looked for a job in 4 weeks, then the Bureau of Labor Statistics kicks you out of the data. They do not consider you part of the labor force after that. And so it's important. They only started doing that in 1994, by the way. So if you look at a long run series of this particular indicator, then you kind of have to make adjustments between prior to 1994 and after 1994. But anyway, that's why it's important to pay attention to a piece of this report that's called marginally attached workers, because these are people who report that they wanted a job, were available to work, but they had not looked for work in the last 4 weeks. And if you are available to work and you want to work, but you haven't looked for a job in 4 weeks, usually what that means is that you've spent a lot of time looking, but it just has not worked out. And so maybe the availability of applications for you to look at, the applications for you to fill out has basically disappeared. You're out of opportunities to even apply for a job. And so after the lockdowns were lifted, the labor force actually expanded in size after it had really tanked and fallen off a cliff during the lockdowns and the economic shutdowns and stuff like that. So the labor force has been increasing in size basically since, the huge trough in March, April, May of 2020. And the April report actually told us that trend is either reversing or at least had a hiccup. So could this be the beginning of the end of the economic expansion? I certainly hate to say it, but there are a lot of reasons from both the labor market and from home builders and from financial markets that say probably, it unfortunately just isn't looking pretty. So I do apologize that I don't have any good news to share with you today, other than the fact that single family homes are probably going to get a lot cheaper over the next several months. But I do hope you've enjoyed this video, and I will see you tomorrow for Supply and Demand Daily. There is no data to cover necessarily being released tomorrow, so I'm just going to be picking a topic and sort of talking about it in a little bit of detail. So I'll let you know what that is, and then obviously release that video tomorrow. I'd like to thank you for sticking with me for these however many minutes, and I hope you enjoy the rest of your May 19th, Thursday, 2022. Have a good one. See you later.